Welcome back. You're here because you want to get smart fast on the topics that really matter.
And today, we're tackling a core part of financial audits.
That's right. Specifically, how auditors react, what they do when they spot potential red flags in a company's financial statements.
Yep. Think of this as getting inside the auditor's head a bit, but without all the super technical jargon.
Exactly. So the focus is International Standard on Auditing 330. That's ISA 330.
Right, and the title is The Auditor's Responses to Assessed Risks. It pretty much says it all.
It does. It sounds like the rule book for reacting to risk in our source material today.
We're working directly from excerpts of the official standard itself, so straight from the horse's mouth, so to speak.
Perfect. So our mission for this deep dive
Is really to pull out the key ideas. How do auditors figure out their plan of action, design the tests they need to do?
you deal with those specific risks they found.
Exactly, and ultimately how that helps them form an opinion on the financial statements as a whole.
Okay. ISA 330, the auditor's responses to assessed risks. Let's jump in. What's the big picture objective here?
Yep.
What are auditors fundamentally trying to achieve with this standard?
The main goal, and the standard is very clear on this, is to get what's called sufficient appropriate audit evidence.
Sufficient and appropriate. Okay.
Evidence about those risks. They've already identified the assessed risks of material misstatement.
Material misstatement. Those are the errors big enough to potentially matter to someone reading the financials, right?
Precisely. Errors that could actually influence a decision. So ISA 330 is all about the how. How do auditors gather the right kind and amount of evidence in response to those specific risks?
Got it. It's about tailoring the response. Now, the standard uses a couple of key terms we should probably unpack. Substantive procedure. What's that?
Okay, so a substantive procedure is basically an audit test aimed directly at finding those material misstatements in the actual figure.
Exactly, get the numbers.
Yes, like checking account balances, looking at the details of transactions. It also includes using analytical techniques, comparing data, looking for odd patterns, that sort of thing.
So really digging into the financial data itself. What about the other term, test of controls? That sounds different.
It is quite different, yeah. A test of controls isn't designed to find misstatements in the numbers directly.
Okay.
Instead, it's about checking how well the company's own internal controls are working.
Ah, the company's procedures.
Exactly. The policies and procedures the company puts in place to, ideally, prevent errors or at least catch and fix them quickly.
So checking if the locks on the doors are working rather than just counting the cash inside.
That's a pretty good analogy, actually. Yeah. Are the preventative systems effective?
Okay, that clarifies those terms. Now, sometimes auditors identify risks that are really broad risks that could affect the financial statements overall, not just one specific account. How do they respond then?
Right. For those financial statement level risks, the standard says the auditor needs to design and implement overall responses. It's a higher level strategy adjustment.
Overall responses, so not just adding one or two extra tests.
No, it's broader. It might involve, for instance, really hammering home the need for professional skepticism within the audit team.
Skepticism meaning don't just accept things, question them.
Exactly. Maintain a questioning mind. Critically assess the evidence. Don't just take management's word for it.
Makes sense. What else might be part of these overall responses?
Well, you might assign more experienced staff to the audit, or specifically to the higher risk areas.
Okay, bring in the veterans.
Right. Another tactic is incorporating more unpredictability into the audit procedures.
Unpredictability, like surprise tests.
Sort of. Changing the timing or the types of tests performed so the company can't easily anticipate the auditor's moves. And of course, it can mean making general changes to the nature, timing, and extent of the work planned.
Keeping them on their toes. Okay, so that covers the big picture response. Now, let's zoom in a bit. What about risks tied to specific accounts or transactions that assertion level risk? How do they tailor procedures there?
This is where it gets really specific. For each significant area, think major accounts, types of transactions, important disclosures. The auditor must design and perform further audit procedures.
Further procedures.
Yes, and the key is that the nature, timing, and extent, what tests they do, when they do them, and how much they do, must be based on and directly responsive to the assessed risks for that specific assertion.
So no one-size-fits-all approach. It's highly customized.
Absolutely. You really have to think about why something is risky. What's the reason for that risk assessment?
What factors do they consider there?
They look at the likelihood of a misstatement happening and how big it could potentially be. That's the inherent risk.
Hmm.
And critically, they also consider if the company has any relevant controls in place that might mitigate that risk.
And if they think the company does have good controls, that links back to tests of controls, doesn't it?
It does. If the auditor's initial risk assessment includes an expectation that the company's controls are actually operating effectively,
They might rely on them.
well, they might test them to see if they can rely on them. Performing tests of controls gives the auditor evidence about whether those controls are truly working as intended.
And are there situations where they have to test controls?
Yes. Sometimes just doing substantive procedures, just testing the numbers won't be enough on its own to get sufficient evidence. In those cases, testing the effectiveness of controls becomes necessary.
Okay, so how do they actually test a control? What are they looking for?
They're trying to get evidence on several fronts. How is the control applied during the period? Was it applied consistently? Who did it? Or what system did it? Was it actually effective in preventing or detecting and correcting errors?
It sounds quite thorough.
Mhm.
And the timing must matter too. You can't just test it once, right?
Definitely not. If the auditor plans to rely on a control for, say, the entire year, they need evidence that it operated effectively throughout that whole period.
So testing at different points in time, perhaps?
Could be. Or examining evidence that covers the control's operation over the entire period. It depends on the control and the risk.
Right. Okay, let's switch back to those substantive procedures, the direct checks on the numbers. The standard says these are always required for material items. Why is that, even if controls seem great?
That's a fundamental principle because, well, controls have inherent limitations. They can be overridden, management might bypass them, or simple human error can occur.
So you can never rely only on the controls.
Exactly. Auditors must perform some direct substantive procedures for all material classes of transactions, account balances, and disclosures. It's their direct line to detecting potential material misstatements in the financials themselves.
Independent verification. Got it. And remind us of the main types of substantive procedures again.
Sure. There are two main categories: tests of details and substantive analytical procedures.
Tests of details.
That's where you're looking closely at the individual items that make up an account balance or class of transactions. Vouching invoices, tracing transactions, confirming balances directly with third parties.
Okay, the nitty-gritty. And substantive analytical procedures.
That's more about looking at plausible relationships among data, comparing financial information with prior periods, budgets, or even non-financial data, looking for unusual fluctuations or trends that don't make sense.
So micro-level checks and macro-level reasonableness checks make sense. Now, the standard calls out the financial statement closing process specifically for substantive procedures. Why that particular stage?
The closing process. Well, that's a critical point where lots of adjustments, judgments, and estimates come together to finalize the numbers.
A higher risk area, potentially.
Definitely. There's often more room for error or even manipulation there. So auditors perform specific procedures like agreeing the financial statements back to the underlying accounting records.
Making sure everything ties out.
Yes. And paying very close attention to material journal entries and other adjustments made during the closing process, especially those made late or that seem unusual.
Scrutinizing those last-minute changes. Okay. What if a risk is identified as being particularly significant? Does that trigger specific actions?
It does. If a risk is assessed as significant, ISA 330 requires the auditor to perform substantive procedures that are specifically responsive to that risk.
More targeted testing.
Often, yes. It usually means more robust procedures, perhaps focusing more on tests of details rather than just analytics, or procedures designed to address the specific nature of that significant risk.
And timing comes into play here too, I assume, for substantive tests.
Absolutely.
Yeah.
Generally, the higher the risk, the more likely the auditor might perform substantive procedures closer to the year-end, or even at year-end.
Okay.
However, they might also perform tests earlier, say at an interim date. But if they do that, especially for high-risk areas,
They need to consider what happened in the rest of the period.
precisely, if they test early, they need to perform additional procedures to cover the remaining period, or ensure controls were effective throughout to get sufficient evidence for the whole year. And if they find misstatements at an interim date, that definitely signals the need for more work.
It sounds like a very dynamic and iterative process,
Yeah.
constantly reassessing.
It really is. Now, beyond just the numbers, the standard also talks about the adequacy of presentation of the financial statements. What's that about?
Good question. It's not enough for the numbers to be mathematically correct. The auditor also has to evaluate whether the overall presentation is fair and complies with the relevant accounting framework.
Presentation, like how things are laid out, yes, and more. Is the information classified correctly? Is the description of financial information clear? Does the structure, the content, the footnotes, does it all provide a true and fair picture? Is it understandable?
So clarity and compliance with the rules on how things should look and be described.
Oh.
Okay. So the auditor does all these procedures, tests of controls, substantive tests, checks the presentation. How do they finally decide if they've done enough? How do they evaluate the sufficiency and appropriateness of the evidence?
That involves a lot of professional judgment. Towards the end of the audit, they step back and look at everything they found, all the results from all the procedures,
Yeah.
and they evaluate whether their initial risk assessments still hold up. Based on the evidence gathered, have they obtained enough high-quality evidence to bring the overall audit risk, the risk of giving the wrong opinion, down to an acceptably low level?
And if they haven't.
Then they haven't finished.
Right.
They need to determine what further procedures are necessary to get that sufficient appropriate evidence. They can't issue their opinion until they have that level of assurance.
Right. Can't sign off until they're confident. Lastly, the standard mentions documentation. What needs to be recorded?
Oh, documentation is crucial. Auditors need to document their overall responses to those financial statement level risks.
Okay, the big picture stuff.
Yes, and then the detailed nature, timing, and extent of the further audit procedures they performed at the assertion level.
The specific tests.
Critically, they need to document the linkage between those procedures and the risks they were designed to address, show why they did what they did.
The connection makes sense.
And, of course, the results of all those procedures. What did they find? If they tested controls, they need to document which controls were tested and the outcome of those tests.
So essentially a clear audit trail showing their plan, their actions, the rationale, and the results.
Exactly. It's vital for quality control, reviews, and demonstrating that the audit was performed properly according to standards.
Well, this has been incredibly helpful. It really paints a much clearer picture of how auditors approach risk. It's not just ticking boxes. It's a thought process.
It really is. ISA 330 forces auditors to think critically about the specific risks a company faces and tailor their work accordingly. The goal is always that sufficient, appropriate evidence.
And knowing these principles, I think, gives anyone looking at audited financial statements a better sense of the work and judgment involved in providing that assurance.
Agreed. It shows the effort that goes into verifying the reliability of that financial information.
So, thinking about this focus on identifying known or assessed risks and designing specific responses, it does make you wonder, doesn't it, for our listeners to consider. How might completely unexpected events, maybe massive economic shifts or disruptive new technologies, challenge this structured approach in the future? How will auditors cope with identifying and responding to risks they perhaps haven't even conceived of yet?
That's a fascinating thought. The landscape is always changing.
Definitely something to chew on. Thanks so much for joining us for this deep dive.